Now, consolidated cash flow statement. So, like we said earlier, okay, for consolidated cash flow statement, we have the additions of the NCI, the associates, subsidiary acquisition and disposal, and also where we have exchange rate difference on foreign subsidiaries. Okay, now for exchange rate differences, we need to understand that there are no cash flows there because exchange rate is not cash movement. Okay, it is not cash movement. Exchange rate is not cash movement, and if it is not cash movement, it's a profit. All right, now, but since it is a profit, it affects the group's profit as well, and also the net asset, especially for foreign subsidiaries. So the adjustment to will now be under the indirect method. If you are using indirect method for the operating activities, you add back your exchange loss because it is part of the non-cash items. All right, it's a non-cash item and a loss has been deducted. All right, so if that is what has happened, then you need to bring it back. So that's for exchange loss. For exchange gain, it's a plus, so that means you need to deduct that from your non-cash items. Adjustment for non-cash items. Also, you adjust for NCI shares in any exchange rate movement. All right, so your NCI share has to be adjusted when computing your dividends paid to NCI. Okay, so that's it. Then also for NCI, dividends paid to NCI is the only cash flow that relates to NCI unless there is subsidiary acquisition or disposal. All right, so where there is no acquisition, there is no disposal. The dividend paid to NCI is a cash flow and it is shown under financing activities because your NCI are shareholders. All right, so that's it. But the exchange rate differences must also be excluded from the calculation in case you have an exchange rate difference. Okay, so that's it. Then also like I said, we always have a question on the pathfinder. Then also associates and joint venture equity. So associate and joint ventures are outside the group for cash flows. Okay, they are not part of the group. So if you are an associate, that means you are not joining the group, you are not consolidating. You are an associate. So you don't consolidate the cash of associate and joint venture. They are not part of the group as well, even if you are a public company. Okay, so you don't consolidate their cash, you only show their cash flows between them, the cash flows between them and the group, and their profits are included in the group's P&L account under the equity, but they are not cash flow. Okay, so that's what we have there, and I hope we can proceed. Can we?
Yes, sir.
Okay, now adjustment under an indirect method. So when you are using your indirect method will tell you that you have net profit, less non-cash. Adjustment for non-cash items before your working capital. Okay, before your changes in working capital. Now, when you are doing your indirect method, you deduct your group share of associate profits. Group's share of associate profit, you deduct that profit from the operating activities because you are consolidating for group and associate profit is not inclusive. Okay, now if you have any group share of associate loss, you need to add that back opposite. Now, dividend received from associates is a real cash flow. It is under investing activities. Dividends are received from investment. All right, so that's it. Dividend received, and then we have dividend paid. Then also we have subsidiary acquisition or disposal. Subsidiary acquisition or disposal. So if any occurred during the year, if a subsidiary was acquired or disposed during the year, and the purchase price paid or received is showed. So of course, a subsidiary is an investing activity, and the net cash acquired or disposed is shown separately. Net cash acquired. Okay, so that's it. Then also you may need to analyze the difference between the total consideration and the net assets acquired or disposed. All right, so that's it. Now, where items go. So your dividend paid to NCI. Hello, don't forget it's under separate financial statements, under separate cash flow. Dividend paid is under operating activities. Am I right? For those of you who did the cash flow statements, dividend paid is under operating activities. Dividend paid is under operating activities. Dividend received is under investing activities. But for NCI, dividend paid to NCI is financing activities, because NCI are investors in our company. So when we pay them, their money, their investments are used to finance our business. It is not our own finance. It is their own finance. It is not our own investment. It is their investment. So their investment is a finance to us. They invested in our company. I hope that makes sense. So that is it. Then also, exchange gain or loss is adjusted for in the operating activities under indirect method.
Yes, sir,
Dividend
please.
received from associates is an investing
Yes, sir.
activities.
Yes, sir.
Yes, sir.
I don't understand how dividend paid is under operating activity. Is it not financing activities?
What's that?
Is that dividend paid? Dividend paid. Is it
Dividend
of
paid.
operating activities or under financing activities?
Okay, so there are two standards for that. There is a standard that talks about people keeping it in operating activities or financing activities. Okay, but the strongest of the standard says that you should put it in uh, operating activities. Dividend paid, operating activities, and this is the reason. I don't know. I think check your Ican study pack. You will see it there as well. Now the reason is that I think I have the Ican study pack here. So when I see it, I will show it to you. Now the reason is that your dividend paid, where do you find it in your financial statement?
Dividend paid is after profit after tax. Profit after tax, then
Is it in your
dividend.
income statement or statement of financial position?
It's under income statement. Then
So if it is in your P&L account, then your dividend paid should be in operating activities. Your P&L account is an operating activity. Am I right?
oh, okay.
Am I right, sir?
You're right, you're right.
Okay. So I will bring the note that discuss the dividend paid. I will bring it out to you. Okay, okay. I don't know. Okay, since I'm sharing the whole screen, right?
Okay, I can see.
Okay, since I'm sharing the whole screen, I'm coming. So let me let me show you something in your Ican study pack as well. So this is a separate financial statement, right? And here they put it dividend paid to shareholders, right? Under financing activity, right? So now let's look at some of the notes. I don't know if it was here or in another material, but hold on. Yeah, IS 7 allows some variation in the way cash flow for interest and dividends are presented to a cash flow statement, although the following should be shown separately: interest received, dividend received, interest paid, dividend paid. Do you understand? Whoa, this one is not talking about it. Oh, okay. Maybe I'll check the uh, FR material. So they are saying that there is a variation. I'll check the FR material and I'll get it across to you, Sean. Don't worry, I'll get it across to you. Okay, so that is that. Now, dividend received from associate is a dividend from investment, right? So a dividend from investment, of course, is an investing activity. Dividend received is from investment, which is an investing activity. Then also we have share of profit or loss of associate. That one will be adjusted for in our operating activities. Then also acquisition of subsidiary. A subsidiary is an investment, so acquisition of that subsidiary is also an investment. Then also disposal of subsidiary is also an investment. Please, if you have any question, don't hesitate to ask. Oh.
Mr. Kazim,
Yes, sir.
please, I'm sorry, I joined the class late. Um,
Okay.
is this topic you are discussing is in the material you sent to us the last time? I've checked, I didn't see
No,
it.
it's not in the material I sent to you.
Can you please share, please, please?
Okay, I'll share it.
Thank you very much, sir.
Yes, sir. Okay. So let's look at dividend paid and interest here. Wait, have I saved this? Uh, oh, okay. No, no, no. I think the center is meant to share the material. They have it, so they'll share it with you guys. The center will share it. I've not shared any material with you before. So they will share it. They have a way of going through the material before they share. But don't worry, after the class you will get the material. Okay?
To me, we send all the materials for us concerning group account. All the
You said?
materials in group account. We send the materials later according to what they told me. For us that paid for the materials. So I was only they only sent the IES materials to me, but
Okay,
the
so I'm sure this one also will be sent to you. All right, just
okay,
hold
okay.
on, we'll share this with you. Now, so for interest and dividend received and dividend paid. Now, for dividend paid, IS 7 allows dividend payments to be treated as either a financing cash flow because they are a cost of obtaining financial resources, or a component of the cash flow from operating activities in order to assist users to determine the ability of the entity to pay dividends out of its operating activities. So, but in examples here, in examples of cash flow, dividends paid are shown in financing activity. So that is what they are using here. Now let's see interest payments as well. So IS 7 states that there is no consensus about how to treat interest payment by an entity. other than a financial institution such as bank. So interest payments may be classified. So which means anybody can treat interest payment anyhow except banks. All right. So interest payment can be treated either as an operating activity because they are deducted when calculating operating profit before tax, or a financing activity because they are a cost of obtaining finance, which is your borrowing cost. Abi? Eh?
Yes, sir. Finance cost is
Okay.
bro.
So in this material, interest payment is put in cash flow for operating activities. Okay. Why dividend paid is put in financing activities. So that is that. But this information is not in your CR. Okay, so that's what we have on that. Then, so acquisition of a subsidiary in the consolidated statement of cash flow. All right. So when you acquire a subsidiary, like we said, it will be under investing activity. So these and these, an example, all will be seen in our uh, notes. Okay, so we have a breakdown here, and we have it for where we have business combination during the year. All right, so we have the format here. That is, you have your fair value of the net asset acquired, less the liability assumed. This one is for you to get your consideration transferred. Okay, then satisfied by your consideration, issue of shares, where you have your total consideration, less cash acquired with subsidiary, then your net cash flow on acquisition. So that is just a formula. So how do we avoid double counting in working capital adjustment? And when we say working capital adjustment, we are looking at changes in working capital, right? Or adjustment of working capital. And what are these working capital? Current asset and current liability. Am I right? Your working capital is current asset and current liability, right?
Current asset minus current liability, working capital.
Okay. So both of them, whether you don't even need to minus it. When you minus it, that means you are looking for the net. Right? So current assets and current liability will give you your capital. Now, this capital, working capital that we have, all right, the movement of working capital in our current assets will have our inventory, we'll have our receivables. Current liabilities, you have your payables, right? All your accrueds, your accruals, your prepayments, all of them are there. Okay, the only thing you will not add is your bank, cash at bank, cash in hand, or bank overdraft, because those are cash and cash equivalents, right? So that's it. Then, so if a subsidiary was acquired during the year, then your opening balance were not part of the last year's closing balance. So if you use the closing minus opening balance, you will double count. Yes. What are we saying? Don't forget, when you are doing your movement of cash working capital, you said, what's your closing balance? Let's say my debtors at the beginning of the year was 5 million. My debtors at the end of the year was 3 million. That means my debtors have reduced. And what does reduction in debtors, what does it mean? What
Reduction,
does
that
reduction
cash
in
out,
debtor mean?
cash outflow.
Reduction in debtors.
Money has gone out.
Cash outflow, reduction.
Reduction in debtors.
It's like we have paid out money to
We have
debtors
paid money.
Eh?
and cash outflow.
Okay, reduction in debtors. Cash has come in.
Cash has come in now.
Reduction. Okay,
Eh?
debtor, creditor.
Our receivable has reduced. So there's cash inflow already.
That's a cash inflow, not an outflow.
Inflow. So I'm taking creditors for debtors. Sorry.
So it means that my debtors have paid me. That is why they have reduced. Right? Am I right, please? So now, if you're now saying that your your debtors at the beginning and at the end of the year have reduced, whereas you purchased this company during the year, you will double count too. All right. So that is double counting. So what do? You have to adjust your balance acquisition. We have an example here where we have an opening inventory of 120,000, closing inventory of 190,000. Subsidiary was acquired during the year when the inventory was at 40,000. All right. So the normal difference you would have done is closing minus opening. So if you have an opening inventory of 120,000 and a closing inventory of 190,000, is that a cash inflow or an outflow? Sorry, me, I don't know how to memorize. Oh. Some people will say that if there is an increase in your asset, it is an inflow or it is an outflow. If there is a decrease, it is an inflow or an outflow. I don't know how to memorize. Oh, me, I like to tackle my questions with reality. So what do you think? If your inventory at the beginning was 120 and then at the end of the year you have an inventory of 190, is that a cash inflow or an outflow?
Cash inflow,
Why do you call it an inflow?
because there is an increase in investment. There's more money.
Yes, do you have anyone else who wants to support or refute or debunk?
Please come again, sir.
Your inventory at the beginning of the year was 120. The
Yes, sir.
question is on the screen now. Your inventory at the beginning of the year is 120. Your inventory at the end of the year was 190. Is that an inflow or an outflow?
It's
Mm.
an it's an
It's a cash outflow.
Why do you call it
It's an
cash flow? Why
outflow.
do you call it an inflow?
We pay. Okay, was one.
at the big 120 at the end 190.
That's
That
closing 190.
Sir, we can't hear you. I think you are in transit, right?
at the beginning 120, at the end 190. So the difference of 70 should be an inflow.
Inflow or outflow?
Me, I go for inflow.
Why do you call it an inflow, sir?
It's because of the inventory is a current asset, and that's an increase in assets. Increase in assets.
Do we have anyone who has a different opinion? Who wants to tackle that?
I feel it's an outflow because money has been paid out to increase the inventory. I really don't know how to interpret these things.
You must find it though.
Please help me.
Okay, now you are right actually, and I will tell you the reason. When you buy inventory, now we already agreed that your closing inventory is 190 more than your opening inventory. It means you have bought more inventory, have you? Maybe our inventory has increased. We have bought more inventory, right? Am I right?
Yes, Mr. Kazim, yes.
So when you buy an
Yes,
inventory, do you receive money or you pay money?
you
We
pay
pay
money.
money. So there's
You
an
pay
outflow
money.
of cash.
So it is an outflow because the double entry principle is that you debit your inventory, which is an asset, and you credit the payment, which is your bank.
Oh,
Oh yes. Now,
yes.
do we
Mr.
understand
Kazi,
it now?
I do.
I
Yes,
told you that I don't know how to memorize, right? And that is me. If it works for you, please just go for it. But as for me, it doesn't work for me. Not that it doesn't work.
Long busting runs as he got left in his body, maybe one in a game, but he didn't even get that, did he?
It doesn't work for me. It definitely work for me. Okay, so that's it. Now, it means that you have purchased more inventory. And when you purchase more inventory, that is an outflow. Okay, now 40,000 came from the date of acquisition, not from operation. Do you understand? Are we there, please?
You see
Are we
some.
there? Hey, is anyone there?
Yes, sir.
Okay, so 40,000 came during the year. 40,000 was what we had at the date of acquisition. So we need to adjust that 70,000 increase. All right. So it will now be 70,000 minus at the date of acquisition, which is also what, how much? 30,000. All right. So that means at the date of acquisition, it will be 40,000. All right. So what we are taking to our operating activities is 30,000. All right. That
Okay.
is uh okay. So this 30,000, that's that. Now the general rule is that when inventory is acquired, you subtract the inventory from the closing balance. All right. You add it to the opening inventory.
Okay.
That is closing inventory minus opening inventory minus additional inventory acquired.
Okay.
If it is receivables that was acquired, we have more receivables. You subtract it, do the same thing. If it is payables, you add, it's also the same thing, sir. It's also the same thing. All right. But whether it is an outflow or an inflow, we will decide that one later. So the first thing is that you subtract the opening from the closing. All right. And then subtract that acquisition. So this ensures that the movement reflects only the operating activities, false changes due to acquisition. All right. So that's that. Now, when we dispose of,
Yes, sir.
I think, okay, this session will end soon. Please, once it
It's
ends,
already on.
kindly join. Sir? Now, disposal of subsidiary. Disposal of subsidiary, we have similar treatment in reverse. Okay, and that is when you dispose of, you show it in investing activities, just like we said. You report your cash proceeds from the sale, and also you adjust for cash balance disposed. Then proceeds from sale, subsidiary. No, 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 no. I'm not using this example. So now we look at we call this a cheat sheet. Okay, so when you acquire a new subsidiary, in your cash flow, you have it in your investing activities. You adjust for your cash paid and cash acquired. For disposal, investing activities, cash received and cash disposed. Your exchange difference, operating activities, you add back the loss and you deduct you less the gain. NCI share of foreign exchange, you adjust for dividend calculation and you remove from NCI the movement calculation as well. Then also working capital items from acquisition. For working capital items, it will be in the operating activities under your indirect method, and you adjust for opening and closing balances. So for purchase of non-current asset, which is your PPE and intangibles, all right, that's your investing activity. So when figures are at net book value, if the statement of financial position shows the carrying amount or net book value, and there is an acquisition of a subsidiary, you must adjust the movement to find the actual cash purchase of the asset. All right. So if I have an asset and then the subsidiary purchased more, if the subsidiary purchased more, what do I do? Eh? So I need to record that one that was purchased by the subsidiary. Now, this will be done here. So why do we have this? The essence of it is for you to subtract your PPE acquired through acquisition because it is not a cash purchase. Okay, your PPE acquired through acquisition. Now, if you acquire a business and you acquire the PPE of your business, that one, if the PPE you have acquired is part of the purchase consideration or something, it is not a cash purchase. You have to remove that PPE. The PPE disposed to isolate the purchases. You only need, but don't forget, cash flow has to do with movement of cash in and out. You acquired the PPE, you did not pay for it. You remove the PPE disposed to isolate for only purchases, and then you add back a non-cash charge, which is your depreciation. All right. So disposal of a subsidiary also, like we said, you record the proceeds from disposal of subsidiary, net of cash disposed. Okay, so that is that. Now, the note to the
Hello, sir.
statement of cash flow. Yes, sir.
Please, is it possible we have this material?
Yes, you will get it. You will get it.
Thank you, sir.
I'll share it with the system now. So the disposal of subsidiary now. When you dispose of a subsidiary, okay? So asset disposed at carrying amount, this is the calculation. All right? The asset disposed at carrying amount has to be stated. The liabilities you are disposing, you less it from there. That will give you the net asset disposal less NCI share of the disposed asset. NCI share of the disposed asset. Then also the group share of the net asset disposed will be there. The P&L on disposal will be there. Proceeds received less cash and cash equivalent in subsidiary. That will give you the net cash flow from the disposal. Now, importance. The importance also is to avoid double counting. So when a subsidiary is disposed of, its assets and liabilities exit the group, of course. And to avoid misstatement, do not include the movement in the assets, inventory and receivables. No, don't include it. Then also you remove its impact when calculating cash flows from operating activities. All right, and just like in acquisition, you only record the net cash effect in the investing section. So that is what we have. Now, other non-cash transactions. Where we have other non-cash transactions, you have to take note of all assets and liability changes resulting from cash flow. Okay, resulting from cash flow. You need to take note of them. So your loan conversion into equity, you need to take note of it. Your finance lease addition, you take note of it. Asset revaluation, you take note of it. Okay, so that is it. Asset revaluation is usually at fair value. That's what we are saying, right? And that fair value is what you are recognizing in your balance sheet. Now, you have to always review the notes to the account or the notes to the account that supports or your supporting workings to separate cash and non-cash movements. All right. Now, the key summary here is that the purchase of PPE, like we said, investing activities. I thought we've discussed this before. Yeah, working capital adjusted in. I think we've discussed all this before. We've written the summary before. Under 20 minutes, can we get a question on cash flow? Under 20 minutes. My class will not exceed 6:30 today. Because I have another class. Under 30 minutes, can we get a question? Yes. Group cash flow. Now we have it in. I'm sending it to the group now. Are we there, please? Hello.
Sir?
Let's hope I'm not the only one in this class.
Hello?
I'm here, sir.
Okay, sir. You
So
were saying something about sending something to the group.
yeah, the diet where we have group cash flow statement.
Okay, sir. Please, may I ask, because it wasn't long I joined, are there prior materials that have been sent in respect of a CR?
Uh, the center has a material, right? So I'll give them mine to consolidate as well. So once
Okay,
we consolidate, they can share all with you.
okay, sir.
So just if you need any material on sale, just reach out to Mr. Ibrahim on the group.
Okay, sir. Thank you very much, sir.
You're welcome. So which one are we taking first? May 2021.
Yeah, what is
Okay,
something?
let's take the most recent one, May 2021, question one, and all of them are question one. May 2016, November 2020, May 2021.
Are we settling for May 2021?
Yes, please.
Okay, sir.
Anyone who has a particular should please share.
I don't know. I have on my laptop.
May 2021. Hold on. Let me share it. I'll send it to the group now.
Okay, sir.
in a group, right?
Yes, sir.
Okay. We solved the question there before, I know. Question one, and this is taxation. Okay, maybe not
Please, what year?
taxation. May
2021.
2021, question 1C. Is it question 1C? Question 1A. Okay, question 1A. Who is reading for us? Most of you are just coming to this class. Hmm.
The
Let me know when we are there.
Feed Me Limited is a company.
Yeah, Feed Me Limited Company.
Feed Me Limited is a company that has been in operations for over 2 decades, producing Trobamo, a natural cocoa powder beverage produced from cocoa beans. 5 years ago, the company acquired 100% interest in Bhutan Nigeria Limited, a company that specializes in the importation of cocoa beans from Cote d'Ivoire. In 2016, Feed Me Limited acquired 40% interest in a competitor company, Food Company Limited, and on January 1, 2019, it acquired 75% in Shawarma Supermarket Limited. The draft consolidated financial statements of Feed Me Limited Group are as follows. All figures correct.
Assumed to be correct.
Assumed to be correct because it's from Ican.
Because it's from Ican. Do you know that I can make mistakes too?
Okay,
Are you aware?
we. I'm aware. I'm aware. I'm
Okay,
aware. But so
go ahead,
can we go
please.
to the loan now? The loan notes were issued at a
Are you taking
discount in
additional
20.
information one?
Additional information. This is additional. Okay, additional information one. There had been no acquisition or disposal of freehold buildings during the year. Information related to the acquisition of Shawarma Supermarket Limited is as follows. All figures. So,
Yes, loan notes.
information three, loan notes were issued at a discount in 2019, and the carrying amount of the loan as at December 31, 2019 included 600,000 naira, representing the finance costs attributable to the discount and allocated in respect of the current reporting period. Required, prepare a consolidated statement of cash flows for Feed Me Limited Group for the year ended December 31, 2019, in accordance with IAS 7 using indirect method.
Okay, so let's look at the indirect method there. They gave us the income statement and the statement of financial position, even without being informed, even without saying indirect method. You should be able to use indirect method with this. I'm not saying you can't use direct method, but of course, indirect method is in this case, direct in this case. All right. Now, so what do we have? Yes. Where do we start from? Profit before interest and tax or profit before tax? Which one? So what's our profit before tax?
If we start from profit after tax,
You know you can start from profit before tax, right?
so that means we still deduct tax or what?
You say?
That means we still deduct tax if we start from profit before tax.
So the thing is this, you can start from profit before interest and tax, not only profit before tax. Because even if you start from profit after tax, eh, the interest and the tax, you need to add them back. Is that not so? I'm talking of normal IS7 now.
Okay.
Your interest and tax, you add them back, because that interest is interest for the year and tax for the year. It does not represent, it does not necessarily, you can say I'm putting necessarily, it does not necessarily represent that that was what you paid. You can have a deferred tax now. I mean, you can have a deferred tax liability or a deferred tax asset. You can have a tax owing, tax of last year that you didn't complete. You can pay the two of them this year. What's our tax paid? Income, you can see they called it income tax expense. Is that not so? Is it not income tax expense they called it? I mean, where is it safe? Income tax is how much? 5,865. Right? So anyone you want to use, whether you want to use profit after tax, or profit before tax, or profit before interest and tax, you are right. Who is that person coming in? Ah, Kai. I think it is now I start to feel while our lecturers or our teachers then used to be angry whenever a student comes in while the class is going on. It is now I understand. So, as we were saying, so profit before interest and tax, or you use profit after tax, or profit before tax, anyone you use is right. If you are using profits after tax, that means you are adding back the tax, you're adding back the interest, because that may not necessarily represent the amount you paid. And cash flow is on movement of cash, not the expense for the period. You can have interest owings. You can prepay your interest. Is that not so? You can have a deferred tax. So all those things, you can pick them. So now, I can pick, okay, let's just pick profit. Should we pick profit? Let's pick profit before tax. Profit before tax is 28,275. Or you can pick profit after tax. If you are picking profit after tax, that means you are taking this back. Your attributable tax attributable to investment, deferred tax, income tax expense. All these three, you will take them back. You add them back. Okay? Then that will give you profit before tax. Then from that profit before tax, what do we have there? Which one are we picking? I'm not sure we can solve this question under 10 minutes. So this is what we'll do. All right? For those of you who are writing, keep taking the notes. In our next class, we'll solve this question. All right? And again, I'm begging each and every one of us. 4:30 is 4:30. Our next class is on Friday, right? And our
Yes.
Friday class is at 7 p.m., right? 7 p.m. is 7 p.m. And now that we have questions to begin with in our next class, I hope you will not come in late, because this question will be solved in our next class.
Okay, sir.
All right? But today, let's just identify these items. You can jot them down, you can jot them down. So we have our profit before tax of 28,275, right? Am I right?
Yes, sir.
Now let's add back our non-cash items. Just like I told you, your interest expense is interest for the period, not the interest paid. You don't know if that is the interest paid or interest for the period. So you need to add it back. Okay? So that is it. Shall we proceed, please? Shall we?
Yes, sir.
Okay, so that's it. So interest expense, you add it back. All right. What again before do we have? That is interest and profit before interest. Did I not say profit before interest and tax? Anyone you want to do. Then what again do we have before arriving at this net profit? Because all the non-cash items that gave you this profit before tax, you need to look at them and ensure that they are cash movement. If they are not cash movement, you add them back. All right. Then we also have income from financial what asset. That one is an income. We leave it. All right. Then also we have share of associate profit after tax. Don't forget we said it that anything share from associates, profit from associates, you less, are you lessing or adding it back? Since you have added it before, you less it because it's not part of the group, right? So you've added the share of profit from associates. You've added this, now you need to less it. Okay? What else do we have here? Yes. What else are we adding back? Income from financial assets, you leave it. The cost of sales, you leave it, right? Now let's go down. If there is any other non-cash item. Hello?
Hello, sir.
Are we together, please?
Yes, sir.
Okay. If there is any other non-cash item, then we need to deduct it. Okay? Can we give what are the other non-cash items? Yes? What do we have in our notes? Is anyone there? Is anyone searching for me? Eh?
I'm searching, please. My laptop is misbehaving, so I went back to my handsets.
Okay,
So
that's
it's
fine.
taking time.
That's fine. So we have additional information, no information on disclosure. We have the loan notes. Loan note was issued at a discount in 2019, carrying an amount of 600. Agreement to refinance at 30%, right? Okay, that one is on the loan notes. So they are still on the operating activities. What else do we have? Is there no depreciation in this question? Do we have any additional information on depreciation? On our non-cash items, depreciations, right? Provision for bad debt, whether it is general or specific. Provision for depreciation, provision for
Depreciation.
receivables. Do we have any of those things? On our balance sheet, do we have? Yes. Do we have? I can see accumulated depreciation here on my plant and equipment, but that one is accumulated depreciation, not in our income statement. What are the items you have in our income
What of
statement?
accumulated depreciation?
Accumulated depreciation is depreciation from the past years.
Okay.
I don't think it is included in our income statement. All right?
Just like
Accumulated depreciation is not in the income statement. So, since there is an accumulated depreciation here, that means there must be depreciation for the year. Let's see if the question gives us depreciation for the year. If not, we need to look for this accumulated depreciation. You might have additional notes for it. All right? Sorry.
thank you, sir.
Yes. Accumulated depreciation, or sorry, depreciation for the year. If we can't get the depreciation for the year, let's look at
I
our.
can't see anything for depreciation for the year.
Oh yeah, now.
Not for depreciation inside the additional information. Only accumulated depreciation in the statement of financial position.
The accumulated depreciation given to us, right? So let's look at when the assets were purchased.
There has been no acquisition or disposal. Okay.
When did we purchase these plants and equipment, as well as the freehold buildings?
Maybe we assume 5 years ago when the company started operation.
Ah, I don't think you should assume. I don't think you should assume.
Or let's say okay.
So if you
Uh,
look at, okay, so I can see something here now. All right. If you look at the depreciation for plant and equipment, depreciation for 2018 was 16.5. Abi?
3.5, 3.5 million.
Now, in 2019, it has accumulated to 18,000. What does that tell
So
you?
the
How
depreciation
much
is
has added to it?
2,000.
How much has added to it?
2,000 has added to it.
Are you sure?
Okay, 1,500, sorry, 1,005. 1,005 has added to it.
So that is depreciation for the year for plant and equipment, right? Eh?
But
That's
that is increase.
1,500.
Eh now?
That is increase now.
1,500 has added to it in 2019, Abi?
But I think is that not an addition?
Is that not what?
Addition to the assets.
We're talking of depreciation, sir.
What I'm saying now, when an asset was 16.5 in 2018 and the asset becomes 18,000 in 2019,
Is it asset or depreciation, sir?
Depreciation.
Me, I'm talking of
depreciation.
depreciation here. Depreciation is what I'm seeing as 16.5 and 18,000, not asset though.
Oh,
So
okay,
how do
okay,
we
okay, okay.
interpret the figures, sir? The excess of the
What is it?
1,500 on it.
Ma?
The excess
It
of
will
the
be big.
1,500 over
Yeah,
2018. How then do we interpret it?
Okay, madam, let me answer your question.
Yes, sir.
before you answer, sir,
I
look at
have
that.
an accumulated depreciation of 16.5
Okay,
as
sir.
at 2018.
Okay.
Now, at the end of 2019, that accumulated depreciation has increased to 18,000.
Yes, sir.
What does that mean? It means I have added 1,500 depreciation to that 16.5
Okay.
in 2019. Abi?
So that 1.5, do we then
Is the
say that is the
depreciation for the year
depreciation for
2019.
2019?
Exactly.
Okay. Thank you, sir. Makuku
Do you
point.
get it now?
Yes, sir.
Okay. Then we have our freehold buildings as well. This one is giving us at a carrying amount. What is a carrying amount?
That's
Carry
the net book value.
Net book value.
Yes, sir.
the cost
Now,
minus
if that is the
depreciation.
net book value,
Cost minus
they told me
accumulated.
that net book value as at last year was
Okay,
how
sir.
much? 33,000.
33,000.
But the net book value as at this year is 31,125. What
1,111.
does it mean?
Yes.
What's what does that difference? What does it mean? Is
Depreciation.
it disposal?
Yeah.
Would you call it a disposal?
Maybe is it disposal or impairment now?
It's either impairment or depreciation, either of the two.
Okay, sir.
You can only have impairment where you have recoverable amount. Oh.
Okay,
Yes,
sir.
sir. Julie?
Eh? So you understand?
Yes, sir.
Yes.
Uh-huh.
I'm getting.
So those are the two things we have there. We'll be rounding up this class now. So any other one? No, we don't have provision, right? So those are the non-cash items. Yes, the non-current movement in working capital. That is our current asset and current liability. So this is our inventory. 29,000 minus 15,000. Abi,
Okay. Yes. If
did we purchase the company during the year? When did we purchase it? In 2016, we acquired 40%, right? Am I right?
I'm sorry,
Hello.
please, I'm a little distracted. The inventories, I think 2018 it was 15,000. 2019 is 29,625.
Yes, and I'm asking, did
Okay.
we acquire this business? Did Feed Me acquire this company during the year, during 2019?
Let me check the note. I don't know.
It's here now. In 2016, we acquired, Abi, which company are we consolidating? In 2016, Feed Me acquired interest 40%, right?
Okay.
Now, Foodco, and on 4th 2019, we acquired 75%.
Okay.
So, which means it was acquired on the 1st of January. So, it was not during the year,
Okay, sir.
it was acquired at the beginning of the year. All right, it was acquired at the beginning of the year. So, that means we can take our changes in current asset and liability, changes in working capital, we can do them straight, right? So, 29,000 minus 15,000 is what?
29,000.
14,625. Is it 625?
14,625.
Is it 14,625, right?
Yes, sir.
Okay. Then 27,750 minus. So that one, is it an increase or a decrease? Is it outflow or inflow?
Inventories. Okay. For inventories, it is an outflow.
Outflow, because it is an increase. There is an increase in the inventory.
Yes,
Then
sir.
27,750 minus 19,125. What does that give us?
Is an inflow.
Trade receivables.
Yeah, what we have to receive from outside. Okay. It's an outflow. Yeah.
Okay.
27. It's an outflow.
Okay. Then also 67 minus 27. Oh, sorry, this is cash and cash equivalent. Oh, don't go there. Oh.
Cash in any.
That's our current asset.
Please,
Don't go
Oga,
to
don't be
current.
angry with me. Oh. I'm a slow learner, but once I grab it, the thing will not go.
We are with you, man.
Thank you, sir.
Shall we proceed?
Yes, sir.
Okay. Then our current liabilities, what do we have there? We have payables.
Current liabilities. Okay.
We have payables. 75 minus 42.
Uh, it's an inflow.
Is an inflow.
Yes. I'm supposed to pay because I have brought in inventories. I'm supposed to pay 4.2 before. Now
Okay.
now it is 7.5.
Okay. Now we have which one is okay? Consolidated income statement. Wait, oh, what is this draft? Okay, this is consolidated financial position for 2019. Consolidated income statement for 2019, right? Then
Yes.
we have an additional information. Oh, we have an additional information. We have inventory. We have 480 as inventory. All this, see, they said information relating to acquisition of supermarket is as follows. We have this one now. We need to consider the inventory as well. All right.
Yes, sir.
We need to consider this one. So that means for our working capital, we need to consider this. So let's take only the inventory. All right. So for our inventory now, 29,625 minus 15,000. All right. Minus what again? Minus this inventory of 480. What do we have? Minus inventory of 480. As we'll be solving this question in our next class. Yeah.
Okay, sir. Thank you very much, sir.
All right. So see you all in the next class. Good night.
Good night, sir.
Good night.